just 1 year ago. The market bottomed March 23rd, 2020, and it was bleak indeed. And here we are, and everything looks a whole lot better, doesn't it? And I'll tell you, Derek, we talked about a year ago, and we said that it was going to be a V-type recovery out of this pandemic and bear market, and it certainly looked like that.
Well, it's certainly looking like it now. I mean, initially, we talked about whether it was a square root. We had all sorts of different symbolism for it. Right. And generally, it really was more of a K recovery up until just recently, as the vaccine is becoming more and more widely distributed, and more people are reaching some level of immunity from the virus. But the thing that's interesting to me is, the flip side of last year is where we are right now. And I just saw yesterday that we had record inflows into U.S. equities, over $50 billion. Obviously, some of that was stimulus money. And we have sentiment levels that are fairly elevated. So it's going to be a much more challenging market environment to navigate going forward, with lots of cross currents.
Well, I think it's pretty safe to say that we're in a different place economically today than we were a year ago. You showed me a quote from the famous Howard Marks, and I'd appreciate it if you told everyone the one that you showed me.
He's one of my favorite writers, and he says, one thing we know is that there's great discomfort today. And he said, all investments begin in discomfort. And Warren Buffett sort of says similar things. He talks about being rewarded for patience, diversified portfolio, quality businesses, and the rest. But sometimes you have extraneous other factors that influence the fundamentals, like interest rates or a drop in the price of oil. We saw both of these things this week. We saw the 10-year go to the highest level since 2015 in terms of the 2 and 10 spread. And we also saw oil down 8% on Thursday on a reduction of believed demand and European struggles with getting vaccines out.
But, there's so much good news as well. We saw an Atlanta Fed number that was a double digits for the GDP report. They did moderate that just a bit, but still a significant GDP number we're expected to have as we go into the summer. So there is some positive news, and that was causing some of the concern after the FOMC report came out earlier this week, when the Fed chair said that interest rates are going to stay low until 2023 if the economy supports that.
Absolutely. And in fact, that's what he said. We're not going to act based on forecasts. We're going to act based on actual results. But lo and behold, the very next day, we got the prices paid index from the Philly Fed, and it did show that prices are up substantially on a year-over-year basis. Powell knows this. He knows we had, a shutdown last year, and so the baseline levels are fairly low. So the question is, will it be sustainable beyond the easy comparisons, which begin sort of June, July, and August this summer?
We've certainly talked a lot about it on this show, but, the Federal Reserve has really two jobs, if you will, a dual mandate. And one of them is price control, which is what we're talking about, inflation. But the second, which seems to be the overwhelming concern, is full employment. And I think they're going to let this thing run hot, if you will, until employment gets to the number that they're looking for. Don't you agree?
Oh, absolutely. And you correctly pointed out when Janet Yellen was named Treasury Secretary, she's a labor economist. She's much more concerned about Main Street than Wall Street. She'd like to see higher wages. She'd like to see a reduction of income inequality. They're talking about $15 minimum wage. So clearly, if running hot leads to some increase in wage inflation, that could be a bigger problem for the Fed than they currently assume. But we did see through the dot plots, a few Fed members actually did suggest that rates might begin to rise in 2022, but they were in the minority.
There's certainly the bond market is one thing, and the Federal Reserve controlling the short end is something else. The bond market may begin to signal something other than what the Fed is expecting. So we're going to both watch the fixed income market, the bond market, and the equities market, because there's opportunities across the entire platform of where you can allocate capital. And if you don't want to go and do all that work on your own, Danny, there's a way to get this done.